a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about anti-ESG investing. And ESG had exploded in popularity over the past few years. And these ETFs also performed very well because they were usually over-invested. They had heavy allocations to big tech stocks like Apple and Microsoft were the top holdings in many ESG ETFs, and they had little or no exposure to energy. So when technology did well, these ETFs did very well. So that is why they gathered a lot of assets. And of course, some investors want to invest according to their beliefs. But starting late last year, because technology stocks have underperformed and energy stocks have massively outperformed. So these ESG ETFs they underperformed, and so that is why they have been losing assets. Inflows into ESG ETFs have slowed down. Some ESG ETFs have closed down as well. And then there were several allegations of misbranding of products, greenwashing to take advantage of this popularity of ESG. So there is increasing regulatory scrutiny as well. So this year we have seen this increasing trend of anti-ESG ETFs. Some anti-ESG ETFs were on the market earlier too. Some have launched this year. So among the ESG ETFs, anti-ESG ETFs that come to my mind are Vice, BAD, MAGA ETF. There's an ESG Orphan ETF, ORFN. There's an ETF, God Bless America ETF, which would launch in the coming months. But the ones that have gathered most headlines, which attracted most headlines, is by STRV, is this firm called STRV Asset Management. This is a company which is asset management company which is backed by some high profile investors like Peter Thiel and Bill Ackman, and this company promotes excellence capitalism. So they want to remove politics from investing, and according to them, big asset managers, particularly the big three, BlackRock, Vanguard, and State Street, they push divisive social and political agendas which cause companies to underperform and harm investors' interest. And the first ETF that this company launched was an energy ETF, which makes sense because energy industry was most impacted by the trend of ESG investing, and because of rising popularity of ESG, energy companies were forced to reduce investments in domestic oil and gas production. And this year we have seen that even though the world is moving towards alternative energy, but the transition is not yet ready. We are still very much reliant on fossil fuels. So it makes sense to continue to make some investments in our oil and gas industry till we are ready for the transition. So let's go to the code page on Zacks.com and take a look at the two ETFs launched by this firm. So the first ETF that they launched is the STRV US Energy ETF, ticker symbol DRLL. And this is very similar to other popular energy ETFs, market cap weighted energy ETFs like IYE. But the difference is that the ETF would use its shareholder voting power to encourage energy companies to drill more and frack more. And this launched just about 5 weeks back, but has been quite popular, has already gathered about 330 million in assets, has an expense ratio of 41 basis points. If you want to learn more about this ETF, you can go to the quote page on Zacks.com. I did a podcast with the provider. You can listen to the podcast. And then using the link, you can go to the code page and you will read more about excellence capitalism. There are There is an investment case for this ETF. You can read more about that. Looking at the top holdings, as I mentioned, market cap weighted exposure to the US energy industry. So very much what you would expect. Top heavy in Exxon and Chevron, almost 37% to 38% of the portfolio, and then ConocoPhillips, EOG Resources, Occidental Petroleum, etc. Now, the second ETF they launched just a couple days back. It is the STRV 500 ETF, STRV, and this is very similar to the S&P 500 tracking ETF. So this provides market cap weighted exposure to large cap US companies. The difference is that they will use your money to encourage companies to focus more on profit over politics, and they have already started writing letters. They have requested Chevron written letters to Apple and Disney to prioritize profits and not ESG agenda. This is very, very cheap, just about 5 basis points expense ratio, so just a little bit more expensive than the cheapest S&P 500 ETFs like BOO and IVV, but cheaper than SPY. And if you want to learn more about this ETF, you can go to the code page, and using the link you can go to the STRV webpage, and this is what you will get in the ETF. Apple, Microsoft, Amazon, Tesla, and Google, these are the top holdings. And in fact, if you see the S&P 500 ETF, the most popular S&P 500 ETF, SPY, you will get a very similar exposure in this STRV ETF. But as I mentioned, the difference would be in using your. Thanks for watching. Make sure to check out zacks.com/promo for an interesting offer, and make sure to subscribe to our videos so that you do not miss anything. And I'll see you next week.